Ever feel like investing is a bit overwhelming? Like there is too much to choose from and you have no idea where to begin? Well, today we're making it simple and I'll show you one of the easiest ways to grow your money. Hey there and welcome to the Market Monkeys channel. It's Julia here and today we will dive into the world of ETFs. Whether you're just starting out or you're looking to diversify your portfolio, this video will be useful to you. For those of you who are just starting, I'll explain in a few words what ETF means and why is it a great way to begin. ETF stands for Exchange Traded Fund. Think of it as a basket of investments all wrapped up in one package. Or imagine you're at the farmer's market. Instead of buying each individual fruit, you could buy a fruit salad. Or for example, my favorite, a pre-made vegetable soup set. Instead of buying a pack of carrots, onions, celery, etc., you get one of each in a single pack. That's kind of like an ETF. Instead of buying each individual stock, you're getting a package of investments in one go. ETFs can contain stocks, bonds, commodities, or a mix of these. They are traded on stock exchanges just like individual shares and you can buy and sell them throughout the day. Now, why should you care about ETFs? Here are some key benefits. First, diversification. Don't put all of your eggs in a single basket. I'm sure you heard this phrase already a million gazillion times. And ETFs is a great way to follow this rule. You're basically spreading your risks across multiple investments. Next up, lower costs. Most of ETFs have lower fees than actively managed mutual funds. I guess I'll make another video explaining the difference between mutual fund, ETF and index fund, but you don't actually need this information to start investing in ETFs right now. The next, as I already mentioned, ease of use. You can sell or buy ETFs just like regular stocks and it makes them super convenient. Another benefit is transparency. Most ETFs disclose their holdings daily, so every day you know exactly what you're investing in. And the last, tax efficiency. Most ETFs have fewer tax issues than actively managed funds because they are designed to be more tax efficient. This means that they tend to avoid triggering extra taxes when selling or buying investments, and by this they're helping you to keep more of your returns. There are many types of ETFs out there and here are a few popular ones. First is index ETFs. They track a specific index, for example S&P500. Next, sector ETFs. These track a specific industry like for example technology or healthcare, or some smaller sectors, semiconductor for those who want to invest into Nvidia for example, or AI for people who want to be a part of Palantir rally. Another type is bond ETF. Bond is a kind of a loan that you lend to a company or a government and they pay you back with interest over time. Another type is international ETFs that give you an exposure to foreign markets, and commodity ETFs that track a price of different commodities from gold to oil to oranges, cotton and many more. Before we jump into step-by-step guide and discuss my favorite ETFs, if you find this information valuable, please support our channel by hitting a like button and subscribing. So what do you need to begin? First, open a brokerage account. Many online brokers offer a commission-free ETF trades. Next step, do your research. Look for ETFs that align with your investment goals and risk tolerance. Here's how. Start by using websites like Morningstar or ETF Research Center to compare different ETFs. Look at what each ETF invests in, it's called holdings, how well it's been performing over time and the fees you will need to pay. Check if the ETF tracks a well-known index like the S&P500 and make sure it matches your goals, whether you want to invest in a specific center, country or asset type. Pay attention to the expense ratio or how much it costs to hold the ETF and how closely ETF follows its index. It's actually called a tracking error. It's also very important to choose ETFs from a reputable provider that have a good track record. You can use screeners to filter ETFs based on your interests like technology, healthcare or international markets. Before we move on, I know it sounds a little overwhelming, especially for the people that never did this before. So I'll tell you a few words about my favorite ETFs. And the first one is WU or Vanguard S&P500 ETF. This is a great option for people who want to invest in 500 of the largest US companies, effectively tracking the S&P 500 index. It offers broad market diversification, making it ideal for a core portfolio holding. With a very low expense ratio of just 0.03%, it's a cost-effective way to invest in the overall US stock market, providing long-term growth potential. And as a nice bonus, average returns of WU in the past 3 years were 9.5%. Next, Invesco Trust or QQQ. This ETF tracks Nasdaq 100 index, giving investors exposure to non-financial companies, including some of the biggest tech giants. It's ideal for people looking to invest in innovative, fast-growing companies, but it comes with the risks. This index comes with a higher volatility, so it's ideal for people who are willing to take risks in exchange for potentially higher performance. Average returns in the past 3 years were approximately 8.5%. And the last one is less suitable for those who are looking to buy their first ETF, but very suitable for those who are holding some stocks or some more volatile positions. And it's Vanguard Total Bond Market ETF or BND. The average returns of the Vanguard Total Bond Market ETF over the past 5 years were around -1.5%. But that's okay, because bond ETFs like BND are primarily designed for stability, not high returns. They kind of provide stability or shield during the market downturns by balancing out the higher volatility of stocks. Plus, with interest rates rising in recent years, bond prices were pressured. But as rates decrease, bond funds like BND could see a much better performance. So basically, I'll repeat myself, it's ideal either for people who want to balance their portfolio or for conservative investors who are looking for steady income. Another great news, you don't need a fortune to begin. You can actually start small, because most ETFs could be purchased by the price of a single share. Consider dollar cost averaging, where you invest a fixed amount regularly regardless of the share price. This can help you out smooth the market's ups and downs. Another advice that I could give you, if you're holding several different positions like ETFs or stocks or whatever you decide to hold, monitor and rebalance your portfolio from time to time. Don't need to do this very often. I would say once in a quarter or once in 6 months, but still don't forget about this. So as you could see, ETFs are a fantastic tools for both experienced investors and complete beginners. Remember, investing carries risks. So if you're not 100% confident in what you're doing, I suggest that you seek a financial help from an advisor. If you find this video helpful, don't forget to like and subscribe. If you have some questions, drop them below in the comment. I'll see you in the next video. Happy investing!